Thanks, Kristen. Good morning, everyone, and thanks for joining us. We just finished our investment committee meeting. So we were pleased to hear the report from Omar and Tim and the Cambridge team, and we're glad that you're joining us today. Just a couple of quick updates from the Montana Community Foundation. Many of you probably know because you might have received part of our annual endowment payout this year, but in March, we completed that process, sending a little more than $4.3 million across Montana to a variety of charitable causes and purposes. And we're just honored to be your partner in that process. Also, we're really proud to, again, be nationally accredited. You probably also remember we were the first community foundation and the last best place to gain national accreditation. And so we've just gone through that process willingly. It's kind of like getting a root canal where you subject yourself to a whole bunch of things unnecessarily to make sure that you can demonstrate to your constituents that you are following national best practices. And we're very pleased to, again, gain that national accreditation. We're also really pleased to say that we're fully staffed, which in this day and age is a feat in and of itself. As many of us know, it's tough retaining and attracting top talent, and that's really important to us. And so many of you may encounter Lana Moyer, who has joined us as our executive assistant, as we've had some internal movement among our staff. Sarah Morris, who was in that capacity, has moved over to our philanthropy team. So please, if you have the opportunity, welcome Lana. And we also have Daniel Hansberry, who's just joined us in our Missoula office as one of our grants and scholarship administrative associates. And you probably also know that our grant making work is exhaustive and extensive across the state, serving a variety of organizations, and our scholarships are as well. And this is scholarship season, and we'll be awarding somewhere around $500,000 to Montana students going off to school or continuing education. So those are pieces of what we do that we're really proud of, and we all know it takes people to do the magic work, and we've got a great group of top-notch talent. So welcome to both Lana and Daniel. And with that, I'm going to turn it over. You don't need me to tell you what we're all about today, because many of you participated in these, but we're really thrilled to have our outsourced Chief Investment Officer team from Cambridge, led by Omar Sanchez, joining us and giving us our investment update. So with that, I'm just going to turn it right over to you, Omar. Thanks for being here, everyone.
Thank you, Mary, and good to see you all. Again, Omar Sanchez, Chief Investment Officer at Cambridge and Chief Investment Officer for the foundation. I'm joined by Tim Shepard, our Director of Portfolio Strategy, and Sam Camden, our Investment Analyst. And so we'll go through performance positioning. We'll provide some highlights on just broader market context, and please, as much as possible, ask questions either on the chat or live, and we'll do our best to answer those questions to the best of our ability. So with that, if we could start on the first page of the presentation, Sam, the portfolio highlights page. We'll start there. And this is as of the first quarter of this year. So as of March 31st, total portfolio assets we show in the upper left-hand corner of the page, 142 million. Performance, we've got a table kind of at the center of the slide here that looks at a couple of different periods. SI is since inception, so that's just close to 6 years at this point. The portfolio is compounded at 9.1%, net of manager fees, net of our fees, against the policy benchmark return of 8.8%. So solid absolute return in and of itself, and some decent value added relative to the policy benchmark. Taking a look at the trailing 3-year return, you can see the portfolio is up almost 11.5% annualized over that period against 10.7 for the policy benchmark. So again, very strong absolute performance, and on a relative basis as well, adding value against the passive alternative, if you will. Would want to note that when you look at that 3-year return, it's a very good return in and of itself, and it has been impacted by, with the exception of this first quarter, it's been impacted by the very strong performance in most major risk assets since the market bottom in March of 2020. essentially coming out of the most acute phase of the bear market related to the earlier stages of the pandemic. Throughout 2020 and 2021 were very strong years for broader global equity markets, and that has contributed to some pretty significant growth in this portfolio, which of course this portfolio has benefited from. What that has done is push up valuations across asset classes, and so as we entered 2022, it's been a bit of a different experience thus far, to say the least. If you recall, at the beginning of the year, we had the Omicron variant surge. Then we had Russia's invasion of Ukraine. All the while, the market was beginning to really start focusing much more sharply on the outlook for inflation and the potential response of policymakers to address inflation by hiking interest rates. And so all of those different factors kind of combined together to lead to a greater degree of volatility, or downside volatility, we should say, in the first quarter of 2022, certainly relative to the last several quarters, a very strong performance out of equity and bond markets. So as of the first quarter, looking at the portfolio return, down about 4%, a little bit of underperformance against the policy benchmark, nothing to really be concerned about from that perspective. And on a relative basis, holding up a bit better than what broader equity markets have delivered over that time frame. Looking at the performance drivers for the trailing 1 year, on a positive basis, positive absolute contribution coming from our US equities and our private investments. On the negative side of the ledger, emerging markets equity and treasuries have detracted from performance. And on a relative basis, very good value added coming from our private investments in the portfolio. That's very important because that portfolio is going to grow over time and become that much more meaningful of a contributor to the portfolio's absolute and relative returns. Emerging markets equity managers as well outperformed their benchmarks. And then in terms of negative attribution, our non-US developed managers, as well as our US equity managers. In the case of our US equity managers, they made a very good return, but were unable to keep pace with the benchmark over that trailing 1 year. So just a few words about positioning, and then we'll kind of frame the agenda here. Overall positioning for the portfolio, you can see a little bit of variance against the target asset allocation. Nothing that we would characterize as material. We have been in the process of rebalancing the portfolio, and the next time we look at these numbers, we'll expect them to be much closer to their targets. But equally, if not more importantly, when we look at the risk profile of the portfolio, in terms of equity market sensitivity, the volatility that we expect to achieve from this portfolio, very much in line with what we're targeting. So overall, comfortable with the positioning. So, pardon me. What we'd like to do today is a couple of things. Very few comments to make about Cambridge for those who are perhaps less familiar. We really don't want to spend a lot of time there. I do want to spend a few minutes on our investment approach, because it very much informs how we think about managing the portfolio, and we think it's particularly relevant today, just given recent market volatility. We have a slide on market returns. I will try to touch on that briefly, and then we'll take a closer look at performance. So with that, Sam, if I could have you go to the first page I think it's page 3. Thank you. And just say a few words about Cambridge as a firm. As you can see, we've been in business close to 50 years at this point. For those who are less familiar, our primary mission is to build customized portfolios to meet each client's unique needs and goals, all in pursuit of outperformance. And we've been managing portfolios on a discretionary basis for the better part of 20 years. And today we have close to 90 OCIO portfolio clients, including the foundation. Let's take a quick look at the investment team on page 4. So this is your investment team. We are your investment team. 5 people on the team at the senior level, plus investment analysts, performance associates, and so forth. Fully integrated, fully at the service of the foundation, and fully resourced in terms of research and operations. We have a globally based research platform, on the ground, boots on the ground, if you will, looking for the best in class investment opportunities that we can find. as well as the operational infrastructure to allow us to implement and execute on our clients' behalf. So with that, why don't we just take a quick look at the overall investment approach, again, because it really kind of informs how we think about and how we manage our client portfolios. As you might imagine, it really very much is grounded in a long-term investment horizon. The key to success is staying invested, staying disciplined, sticking to your investment strategy, particularly in more challenging markets, to benefit from the long-term upward trend in markets, particularly equity markets. To benefit from that trend, you need to stay invested. And to be able to stay invested, you need to have confidence in the strategy. And to have confidence in the strategy, you need to have a strategy that fully aligns with the foundation's unique ability and willingness to take risk. We build what we're referring to as growth-oriented portfolios. That means they're equity-oriented to really drive the long-term performance potential of our client portfolios. And we diversify those portfolios to handle multiple market scenarios that the market might bring. The idea here is not necessarily to build portfolios that completely immunize the portfolio from risk. That would be impossible, but to allow the portfolio to withstand inevitable equity market volatility so that we stay invested and benefit when markets recover, and they always recover. So what are the tools that we use? Very much big believers in active management. We use active management when we have a high degree of confidence that we can be paid for investing in those active managers net of fees. We know that active management is very hard. The bar needs to be high. And so as a team and as a firm, we believe very deeply in leaving no stone uncovered as we search for value added. What that means is that we will often allocate to, in this case, diverse firms that may be underrepresented in client portfolios if we think they offer the potential to really drive value added in our client portfolios, as well as managers that look at extra financial, let's say, criteria as a way to risk manage their companies that they're thinking about investing in and identify particularly compelling investment opportunities. I will also tell you that we are big believers in private investments, clearly subject to each client's unique risk and liquidity preferences. But as long as we have those things understood, our goal is to do as much as we can consistent with those constraints, if you will, because we think they represent the greatest performance potential that we can add to a client's portfolio, both on an absolute and a relative basis. We are not market timers. I want to be very clear about that. And in a moment, we'll show you an exhibit that hopefully helps demonstrate why. We will, from time to time, make what I would characterize as modest valuations-based tactical tilts relative to policy. So maybe we'll be overweight a specific on asset class. Let's just say, for an example, US equities, if we think they're extremely cheap, and underweight another asset class if we think it's extremely expensive. We'll do that selectively because first and foremost, we think our main point of competitive advantage is our ability to pick managers that can outperform their benchmarks over time. And we're more likely to do it when we think valuations are particularly in our favor, or there are tailwinds particularly in our favor. What that likely means in practice is that we're more likely than not to overweight equities when they're extremely cheap. Because when you look at that type of approach, if you will, historically speaking, the risk reward has generally been in your favor. That's typically when we're gonna make those tilts, and they're generally gonna be quite modest again, because we're really trying to have the bulk of our value added come from picking great managers. Integrated risk management, our process is comprehensive and integrated throughout our investment process. It begins with setting the right policy for the foundation, asset allocation, strategic asset allocation targets and ranges, position concentration limits, benchmarks, and so forth. That really becomes our rule book to then execute the portfolio. It's also about portfolio construction, building well-diversified portfolios by strategy, by style, by capitalization, sector, etc., as well as putting a portfolio together with managers that can add value in different ways so that we can hopefully deliver a more consistent performance over the long term. It's thinking about and being very thoughtful around position sizing so that we make sure that no one position determines success or failure. And it's the day-to-day blocking and tackling. It's portfolio management, it's rebalancing, it's understanding the bets that we have in the portfolio and working as hard as we possibly can to mitigate any unintended bets that we may have relative to how we want to be positioned. In any case, it's really comprehensive, holistic, and it's a part of everything that we do. So I just said that we are very unlikely to market time. And so just to demonstrate why that's the case, Sam, if I could have you go to the, I think it's page 8. I'm sorry, page 9, apologies. Thank you. And we'll just focus on the top chart here. The bottom chart would make the same case, but I think it's easier just to focus on the top. First of all, what are we showing you here? We're showing you the average annual compound returns of the S&P 500 over the last 40 plus years. And so as you can see, US equities have compounded at just shy of 12% over that period. Then what we say is if you had just missed the 10 best days, in those 42 years, what would your return have been instead? 9.8%. So almost 200 basis points of difference. If you had missed the 20 best days, you lose another 140 basis points and so forth. Now, even if you just compare the 12% annualized against the close to 10% for the less 10 best days, it's about 200 basis points of difference in performance. That may or may not seem significant, but it's incredibly significant compounded over time. On a portfolio of $100 million, the difference, 200 basis points of performance over 10 years is a difference of about $50 million. So it's real in terms of the impact. And so the key again is to really not kind of play the short-term game, not market time, but stay focused on staying invested, understanding that there's going to be volatility, but having confidence in the strategy, which will allow you to stay in the game until markets recover. And so that's really kind of a key point in kind of how we think about investing. So with that, maybe what I'll do is just say a few words about kind of broader market outlook, and then we'll transition over to Tim to spend a few more minutes on performance itself at a deeper dive level. Sam, if we could go to the first page in the portfolio update section, market returns. So we're showing you here asset class returns across different major equity, bond and commodity markets and so forth. We're showing you for calendar year 2021, just for some context, and then for the calendar year to date, and this is as of April. The first thing that you'll note here is that in contrast to 2021, where we had very, very strong returns out of most major equity indices, with the US leading the way at just shy of 27%, this year, of course, has been a much different story. Most major markets down above double digits, in certain cases close to 20% down when you're looking at European equity markets. So I mentioned at the outset, what were some of the drivers? Omicron, Russia's invasion of Ukraine, but really inflation and interest rates, I think, are particularly top of mind for most investors. So we are very cognizant of those risks. As I said at the outset, we are long-term. We've built a portfolio to handle multiple scenarios, and so that's really where we're keeping our focus. In the near term, what I would tell you is that notwithstanding those risks, inflation, interest rates, we would argue that the fundamentals from an economic perspective still remain relatively healthy, whether you're looking at things like GDP growth, whether you're looking at things like labor market conditions and earnings growth. And historically speaking, and by the way, this doesn't mean that this has to be the case this year, but what I will tell you for historical context, if nothing else, is that typically when the economy is growing, meaning it's not in recession, and you have positive earnings from companies, that tends to be a fairly supportive backdrop for risk asset markets. And so does that mean that we end the year in positive territory across equity markets, for example? We would be the first to tell you that we don't know, and we're really not going to make that forecast. But it wouldn't also surprise us given these fundamentals. At the same time, we understand that there are risks to the outlook, as I said, inflation first and foremost. This portfolio is built to handle that and kind of ride that out, if you will. We have dedicated exposure to investments that are referred to as TIPS, inflation-linked bonds, essentially, which can provide a degree of insurance to the portfolio, particularly during periods of high inflation. We have exposure to companies through the managers that we're invested with, not all of the managers, but a handful of the managers that we're invested with, companies that have more of a quality orientation, companies with more resilient earnings, more recurring revenue, and most importantly, pricing power that should provide a degree of resilience if inflation persists. And then over the intermediate term, equities should ultimately adjust to inflation. And so what ultimately, we need to be able to do is buy time until inflation is trending in the right direction. And if we can do that through our portfolio construction, this portfolio is going to be fine. Interest rates obviously have been backing up. Everybody is aware of that. We do expect the Fed to continue hiking. At the same time, what we would tell you is that, again, to the degree we start to see inflation trend downward and in the right direction and do so on a consistent basis, that gives the Fed more flexibility to moderate the pace of those hikes, to think about the magnitude of each of those hikes, which likely would be very beneficial from a sentiment perspective and likely means, risk assets would respond quite favorably. In and of itself, the bond allocation that we have in the portfolio, very much high quality treasuries, about 13% of the portfolio today, enough to provide insurance, particularly in more recessionary environments, which is exactly why we have them, but not enough to determine success or failure in the portfolio. And so while we will see a fair degree of mark-to-market volatility in that part of the portfolio, it is important to remember that if we can hold those bonds to maturity, we will get paid a positive yield. And so you do have to kind of think about the mark-to-market volatility within that context. The other thing, and we mentioned this to the committee earlier, from a prospective basis, the silver lining to rates going up is that the prospective returns of those bond investments become that much more attractive. And so it sets the bonds up to do better going forward at this point. So with that, why don't I pause and hand it over to Tim to walk through performance a little more specifically.
Great, thank you, Omar, and great to see all of you today. Thanks for jumping ahead, Sam. Here's a page. Top of the page is portfolio growth in dollars. Bottom of the page is portfolio performance over a few different annual time periods. If I draw your attention to the top of the page, the foundation portfolio finished the first quarter with $142 million in market value. Since the middle of 2016, which is that darker bar to the left on the top, which is when we started working with the portfolio, the starting amount was $64 million. So that means that the portfolio has grown over a time period about in between 5.5 and 6 years, from that $64 million to that $142 million mark, which is a total increase of $78 million. That means that the portfolio has more than doubled over that time period. Part of that is that there have been meaningful inflows into the portfolio. So if you have meaningful inflows, coupled with that starting $64 million that has compounded, has all compounded, which has allowed the portfolio to really grow and more than double to that $142 million mark. So, Omar was talking about the power of compounding earlier. This is a way to see it sort of in real time that it has happened. So from a performance standpoint, that's again the bottom of the page. Portfolio has annualized over 9% since inception. Again, time period just shy of 6 years versus an 8.8% return for the policy benchmark. So some decent value add there, as well as just from an absolute standpoint, pretty solid returns. First quarter of 2022, it has been a bit of a volatile start to the year. Portfolio down about 4%. And as a reference point, global equities are down over 5% over that same time period. If we, again, I think it's important to look back even farther, that just because there has been a little bit of a downdraft in markets, that this first quarter does follow really 3 incredible years for asset returns. If you go back to 2019, portfolio up over 19%. If you go back to 2020, portfolio up just shy of 16. And then just last year, which already feels like a lifetime ago, even though it wasn't actually that long ago, portfolio up just shy of 15%. So for the trailing 3 years, portfolio up almost 12%. And that's, again, despite a little bit of volatility that has occurred in the year to date. If we jump ahead to the next page, we'll take a look at performance, but we'll disaggregate it by asset classes. Top of the page is that year to date. That's, again, through data has through March. So year to date, first quarter top, trailing 1 year period at the bottom. The story to start the year is that there really have been few places to hide. Most major asset classes have produced negative returns through the first quarter. The portfolio's equity portion did trade lower, roughly in the mid-single digit range, depending on the geography. Global equities were down 4%. US equities were down 5.8%. Developed ex-US equities, developed ex-US is markets like Canada, Japan, the UK, down 7.2%. And then emerging market equities down about 4%. The lone bright spot, I'll draw your attention, you'll see it kind of jutting out on the page. It's an orange bar. That's commodities. So when you think commodities, you think of, the ones that come to mind, at least for me, tends to be oil and gas. There's a few other things. There's agriculture, there's metals, but the story is, you all probably know when you go to the pump, oil and gas assets have traded up materially over the first quarter, and then even over the 1 year period. And that has really dragged commodities up. And that means our commodity exposure up almost 25%. Elsewhere, fixed income related assets have traded lower modestly, though, and that's as rates have ticked up. Let's transition to the bottom half of the page, a little bit of a longer time period. This is the trailing 1 year time period. Similar to the first quarter, commodities have been a real bright spot. A portion of the portfolio is up nearly 50%. Elsewhere, equity performance has been mixed. If you look at US equities, they're up almost 13%, while emerging market equities down around 7%, which was quite a deviation between markets. Our Treasury inflation protected securities, the TIPS allocation have held up nicely, up about 4%. Treasuries down modestly at 2.9%. It's hard to see, but our diversifying strategies or uncorrelated strategies, it's a little bit of a purple bar. They've held up and they've eked out a return. Granted, it's pretty low, but they've eked out a positive return at 1%. And then another story, and I'll talk about it on the next page too when we look at longer time periods, but it's important to highlight because it's a very important part of the portfolio, is private investments. The reason they're not on this page is because private investments have a lag with when they report. So right now we have private investments through the end of the third quarter last year. That's because the underlying companies have to close their books and it just takes a long time. But the story is that private investments have been doing very, very well and have been meaningfully additive to performance. And I'll throw some numbers to give you a little bit of a better idea when we jump to the next page, which Sam, if you could just go ahead one more page. Thank you. Same exact chart, which is disaggregating performance by asset classes. The thing to point out here is that the top of the page is 3 years, bottom of the page is that since inception time period, 5 years, 8 months. For the trailing 3 years, which is again the top of the page, US equities have done very well in absolute terms, returning over 17%. Global equities up about 13%. Developed ex-US equities are up over 9%, and then emerging market equities are up 6.8%. Diversifying strategies, which I mentioned was hard to read on the last page, a little bit easier to read here. They're up over 7% and comfortably outpacing their benchmark. Commodities, given their recent run, up 15%, while TIPS up 4.4%, Treasuries up 2.1%. And that brings us to that total portfolio return over this 3 year time period of 11.7% versus a 10.7% return for the policy benchmark. Finally, we'll jump to that since inception time period at the bottom. Somewhat similar story to the 3 year time period. Equities have done very well and been helpful to absolute returns. US equities up over 15%. And each other equity region up solidly, but trailing US equities in terms of returns. Global equities up about 11%. Developed ex-US equities up about 8.8%, and then emerging market equities up 7.6%. I said I'd come back to them, so I'm going to do that now. private investments. Now that, we have this, we're looking at this since inception time period. Private investments, including underlying strategies such as private equity, venture capital. And as I said, there's a bit of a lag in performance. So we don't even have performance all the way through March, but it's worth pointing out that they have been a significant contributor to performance. They're actually they're up 37% since we started investing in private investments at the beginning. And as you can imagine, based on what you see here, that's meaningfully outperforming public markets, helping total portfolio performance get to that above 9% figure versus an 8.8% return for the policy benchmark. So there's a lot of ground covered, a lot of numbers. That's the last page we had for performance. So maybe a good opportunity to pause there, really to see if anyone has any performance related questions, or if anything else that Omar covered, or if you want to jump in, Omar, and put a finer point to anything, please do.
Questions?
I don't see anything in the chat. Hi, Sue Warren. I see you paying attention. I just want to maybe make a couple comments, Omar and Tim, if that's all right. And that is, obviously we're all paying attention to what's happening in the markets these days. I think we've been pretty fortunate over the recent few years to have really amazing returns, and we're in a little bumpy period. I would think it's safe to say that we're all paying attention. We're not panicking. We feel like this portfolio is well positioned to withstand the period that we're currently in. The confidence that you all continue to show, it's been remarkable the last couple of years to see, frankly, some astronomical levels of giving coming in to support charitable purposes across Montana. And so we're really honored to be your partner in that process. We hope that these investment webinars are helpful to you all, so you understand or get a glimpse into the things that our investment committee is paying attention to and that our board is paying attention to. I can appreciate that sometimes some of this language might feel a little over our heads. I'm speaking for myself, to be honest. Like sometimes I have to really think about the terminology that Omar and Tim are using and focus in on those slides and the information. And we do have the benefit, frankly, in the committee meeting of having this information well in advance, so we're able to discern what they're talking about, what they're communicating, and what they're messaging to us in order to make good decisions at the committee level with a long-term investment horizon. So with that, I just wanted to make those points to you all to understand that we understand that we're not all investment experts, and we're really pleased that we do have investment experts that help us craft this portfolio and put our ship headed in the right direction to meet our long-term investment objectives, which of course is what our endowment is all about, is looking at a long-term investment horizon, a 20-year return. We're not timing the market, all of the things that Omar and Tim said. So with that, Kristen, anything in the chat, any questions, just know that this will be archived on our website. And if you think of questions after today's webinar, please reach out to us and we will do our best to answer them or get them answered for you. But with that, maybe pause for any additional questions or closing comments that Omar or Tim would like to add. Or maybe Sam wants to say something. She's always very quiet.
Well, I would just say, Mary, and we mentioned this on the on the call. Our job is to continue to make sure that we're building a portfolio, maintaining a portfolio that can handle what comes. We don't know what's going to come. Arguably the environment is not arguably, the environment is very challenging right now. But again, the portfolio is built to handle different types of market scenarios. So we're doing that work. And then we're also, as always, trying to look for ways for how can we improve the performance potential of the portfolio, be it manager upgrades, be it new private investment commitments. And that's really where we're trying to focus our time. And what I would say to you all is, pay attention to what's going on in the markets, but also take it with a grain of salt. There's a lot to be said for newspapers needing to sell and have headlines that can sometimes be a little bit jarring. But that's also why you have us, to really try to take that long-term view and to try to shut out the noise so that we can stay focused on implementing the strategy in a very disciplined way. And that's what you can count on us to do going forward.
I'm scrolling between the screens, looking at the faces I can see to make sure that I can somewhat read people. Without anyone jumping in and asking questions, I think we're ready to close out. Sharon, Sue, I can see you both. Looking good today. Thanks, ladies. All right. Everyone, thanks for joining us. Thanks for listening in. Thanks for patching in. And we'll archive this on the website or file it on the website. So if you want to go back and listen to it again and again and again and again, feel free. So thanks and have a wonderful week, everyone. Take care. And thanks,
Take care.
Omar and Tim and
Thank
Sam.
you. Bye-bye.
Hi, everybody.
Bye.
Bye, thanks.